Look, the market crashed 2 weeks ago. I've been doing this a long, long time. I've been a student for a long time. I don't even like to be called a teacher because I'm still learning. Really what we're hoping to do is someone says, you know what, this seems learnable. Maybe I can start learning it and maybe this is a solution for me. And please listen to this, everyone. I don't want to be a beggar, but please listen. These returns are bigger than we normally get because the market has moved. I wouldn't want anyone to think this is regular. This time right now with this volatility is what's causing these big returns. Normally it's nothing like this. And we said, let's go from being traders to investors.
We see a really big drop in real estate markets. I'm going to allocate probably the majority of my money into cash flow real estate. That's an asset that I would love to buy a lot of and hold for the next 20 years. You need to put those triggers in place so that it allow you to make a decision that's not based on emotion. And you have to follow that system, because if you don't, you're like, oh no, that's when you're going to run into trouble. So how do we save ourselves from ourselves? Going back and again, looking at lessons learned from 2008, you want to reduce and get rid of emotion, and you want to buy yourself time. And so the more time you have to outlast any of these market conditions, the better you are. Don't think the world is going to fall and sell all your stocks. Don't think that this is going to end next month.
Welcome to episode 2 of Crisis Investing 2020. Episode 1 had so much great content in it, and I think really lifted us as far as saying we have more confidence in what we know and understand, and we're going to gain momentum now in episode 2. We have Andy Tanner, and I have to say this was an extraordinary presentation. This man is a fountain of information, but he wasn't just telling us what he was thinking, he's showing us what he's doing. I mean, literally showing us with screen sharing, looking at the kind of trades he's doing, understanding the market right now and what the opportunity is in the market. You're going to love Andy Tanner, so make sure that you remove distractions to listen to him. And then right behind him, Mike Dillard. I have so much love and respect for Mike Dillard. He is somebody that is a very thoughtful, very intelligent human being. He shares his experience from the past when there have been other economic downturns, and then also tells us exactly how he's looking at things today. And he spends some time, actually a good amount of time, talking about Bitcoin and cryptocurrency and what this whole economic downturn might mean relative to that. So if you have an interest in that, you're going to love that interview. Also here, we're just starting episode 2, so I want to remind you, share this with other people. There's still time for people to get in for the free viewing period of Crisis Investing 2020. I encourage you to share this information. We couldn't be more excited than to share it with you because of what we learned. So let's jump right into episode 2. I am really excited about this interview. Anybody who watched Money Revealed knows Andy Tanner, and we got extraordinary feedback from his segment. Andy has a lot of knowledge. He's very humble, and he's actually, I think, got a lot more achievement and accomplishment than maybe he likes to let on about. But ultimately, what I know is that he's a guy who's been a committed learner in the realm of wealth development. And right now in this circumstance, he's got real context and perspective about investing during a crisis. And not only that, it's not just like abstractions and, here's things to think about. He's actually doing things real time that are working, and he's sharing. He's a Rich Dad advisor. He's written books, and we can get into accolades. That's not the point right now. The point right now is to say people are a little bit shell-shocked. We're in an unprecedented territory right now. There's a couple of options. One is to freeze, try to hold on to whatever liquidity you can, lick your wounds, see what kind of emerges. And I wouldn't fault anybody for feeling like they need to do that. But at the same time, the economy recovers when people start to enter back into it, not when they all sit out and freeze. So in my mind, it's a win-win-win when people get good advice, they take action on it, they have some focus and concentration, they know how to mitigate their risk, they know how to create some upside, and they start a market moving again. And when that happens, everybody benefits. So, without further ado, Andy, I want to say thank you for taking the time to share with us. I've seen some of the things you're doing. I've been enormously impressed by it, and I know you're going to deliver a huge amount of value for the people who are watching.
Well, thank you so much, Patrick, or doctor. I should call you doctor, but thank you so much. But thank you so much. This has been a very emotional week, I know, for a lot of people, and I know it's been emotional for me. I felt such a weight to try to do my best to share. The time to learn first aid is not when the car wrecks, and yet at the same time, when someone's hurting, you've got to do the best you can. And I just remember I wear my, as you know, and we have a lot of mutual friends. I wear my emotions on my sleeve, and I've done so much teaching trying to catch people up that the weight of that responsibility sometimes gets me a little choked up. So I'll hold my composure here with you, but it's been very emotional. I remember I did a little webcast last week, and there were some people on there from Italy. And they said, Andy, we're sheltered in place. We're going through it, but we're here to listen to what you have to say. And the weight of that, to think that they would take time to listen, was so humbling. And the weight, it even gets me a little lump in my throat thinking about what everybody's going through right now. So I'm going to do what I can to catch people up and share with them, I think, what are some very practical things to think about as you deal with this, so many different fronts.
Thank you for that, and I know that you truly care, and that this is something that is very hard driven for you. So thanks for being here, and thanks for caring as much as you do.
Thank you. And one other thing, I was diagnosed with influenza A, so I've got a little bit of a cough from influenza A, tested and verified. So if I cough a little and I don't get a chance to mute my mic, please forgive me. But I'll do the best I can.
I'm sorry to hear that you are dealing with the flu right now. I guess in a sense, I'm glad it's not a coronavirus, since that seems maybe could be a harsher experience. But nonetheless,
we're safe.
You're not feeling even great, but you're ready to serve. So thank you for that. Where should we get started?
If I were, if this thing just hits, right, and the market's falling and crashing, the first thing that I would tell people is say, do we want to behave like an investor? Do we want to behave like a consumer, or do we want to behave like a trader? And I think either the first one or the last one is best. So maybe what we ought to do in our time together is talk a little bit about how investors think during this time, and then what they do. And then we'll say, and that's for people that want to invest. Maybe you've had a little money on the sideline. You say, gee, are there opportunities here? Are they going to get even better for me? And it's very difficult to talk about that, to be opportunistic when people are hurting. I don't like the idea of buying out Costco's toilet paper and then selling it on the side of the road like I've seen people do. That's not what we're talking about. We're talking about being investors, being responsible with our money. And then we'll talk about people who maybe don't have as much to start with, but they would like to find opportunities. And most importantly, we're going to talk about protecting what you have, and defense as well as offense. So those are all things we'll have, I think, sufficient time to talk about. Investing is very different than trading. Let's talk about the difference between the two and what we practically are doing right now and what people can start learning. The good news is, obviously it would have been better to start your financial education, a year ago or 2 years ago. But you know what? You deal with what emerges and do the best you can. So maybe what I'll do is start by sharing my screen. So right here, there's a lot of fear in the market. And what I'm going to bring onto the screen right here is something we're going to start here. This is called the VIX index. It's the market volatility index. And I brought in about, from 1996 up to here. So whatever that is, a few years. And you'll notice a huge spike right here in the year 2008 and 9, where we had the subprime meltdown. Just shows much fear is in the market. And the way this works is for investors and traders is it tells us how much people are willing to pay to insure something. So let's move out of the stock market for a minute and let's talk about insurance. If you were an insurance salesman and you lived in New Orleans and you saw Hurricane Katrina off the coast in the Gulf of Mexico, you saw the storm coming, insurance would go way, way up because the risk or the perception of risk goes way, way up. So because this measures something very similar, people don't need to understand it perfectly right now, but it's earned the nickname the fear gauge. And notice this, that in 07, it took a couple years to hit a peak here. A couple years as the fear built, and the real estate market, maybe we're struggling, and then it hits, and Lehman Brothers and Bear Stearns, and we go back down. Boy, you look at here, wow, 3 months ago, we were close to the lows of fear. We weren't fearful at all, and this hasn't taken a year and a half to climb. 2 months. 1, 2, boom, 1, 2, and we're feeling tremendous fear. And I don't know if this is going to continue or not, but we'll start with, how do I invest in a market that's so volatile and fearful? So I'm going to start with 3 reasons that I think there's fear. Number 1 is nobody knows where this is going to go. Nobody knows where the bottom will be, and no one knows how long it'll last. A lot of people want to interview me, Patrick, and say, Andy, answer these 3. You're supposed to be a teacher of this stuff. Answer those 3. And I'm going to look everyone right in the eye, and I'm going to tell the truth. I don't know. I don't know what direction it's going to go tomorrow. I don't know how long this will last, and I don't know where the bottom will be. And if I can add to that an opinion, I don't think anyone on CNBC or anyone anywhere knows the answer to those questions, and if they say they do, they either fooling themselves or they're not being truthful. And so one of the things I've tried to do as a father with my sons is say, investing has always been about uncertainty, because not only do I don't know this now, I never know it. I didn't know it 2 months ago or 2 years ago. And so a true investor is going to learn at the outset right here today that we're going to learn how to deal with uncertainty. And I think what you're going to see is I'm going to show you some example trades, if you'd like, of how we deal with that. And when I get to these trades, you might say within yourself, wow, I didn't realize that we could create positions where we were comfortable with whatever direction the market would go. So with that, maybe we talk about investing for a minute. Would that be okay? I don't want to dominate everything.
Yeah, let's do that.
Let's begin with this idea, and I'll just use the slide. We're going to talk about both investing and trading, as I said, and let's just make this fit nicely right here. First, we'll talk about this side, and all of these companies that I'm showing you here are Warren Buffett companies. They're owned by Berkshire Hathaway, the great investor Warren Buffett. And you'll notice that he was on CNBC a couple of weeks ago. He just out of timing had released his letter to Berkshire Hathaway owners. He talked a lot about reinvestment of net earnings, and it just so happened that was like the first day the market started falling apart. And on CNBC, they were interviewing him, and they said, "Oh, Warren, Warren, Mr. Buffett, the market's falling, the market's falling, the market's falling. What should everyone do?" And like he always does, he sat in his chair. He said, "Well, I don't know what the market's doing in the short term. I really don't know. I don't think anyone does, but I feel good about the businesses we own." So maybe I'll write that down is investors, in my chicken scratch here, investors look at a business like a Jack in the Box, like this. And maybe we have a crank on it and a little slot. And if we take Coca-Cola, for example, Warren Buffett is probably more interested in the beverage price than the company stock price. In other words, he says, look, are we going to be able to sell Dasani water and Sprite and root beer and Coca-Cola beverages? Because when a company does what it's supposed to do, money comes out. It's that simple. Now, when he bought this, he had a price tag, which is called the stock price. And I'm going to submit to you that an investor, once they look at it as owning a business, are much less concerned with the ups or downs of the stock price than they are with what they paid for it and what their return on investment and growth will be from that. So if I could use this analogy, you and I, we spend a lot of time, in Deer Valley and Park City and in Utah. And if you live in Utah, you've probably purchased some furniture from R.C. Willey. And a few years ago, Warren Buffett actually bought R.C. Willey. A lot of Utahns don't know that. You can't trade it. It's not a stock. It's just a furniture company. I'm going to venture to say that during this crisis, that Warren Buffett is not going to run down to the R.C. Willey parking lot and put a for sale sign saying, I'm willing to sell my business at half price because I'm nervous. There's no way he's going to sell R.C. Willey in this crisis saying, oh, I better get the money out that I put into it while I can, half price. And yet people are selling Delta at half price. People are selling Apple at a very reduced price. People are selling because traders are focused on the price of the business, the stock price, rather than being in the business of flying planes, giving people ketchup or Coke. So does that make sense that a true investor looks at this as a business that they own? They're more interested in the sale of beverages than the stock price. Does that make sense?
And I think it's a great distinction, saying, an investor is somebody that says, I see ongoing and long-term returns from this investment I'm making. Traders are saying, hey, I don't really care about a stock. I care about being able to flip, being able to flip it as compared to hold it. Yeah.
That's right. So this is going to be very important for our discussion and if you're following along at home with Patrick and I, you might even say it out loud. It's like investors own businesses. They do not care about stock price. They care about, once again, something we're going to talk about called cost basis. Now, on the other hand, traders care very, very little about what these companies sell. They are obsessed with the stock price, which is fine, because there's been billions made both ways, both styles. And these guys care more about where the stock price actually goes, something called time decay and volatility. We can learn that another day. But right now, let's focus on this side of how investors behave and how they think about this with one more little example that I think will be helpful as we dive in. This is the power of cost basis. Now, I said I don't know what's going to happen to the market. I really don't. I do have some suspicions long term. If you were to be here with me live, and I could ask you this question and have you respond as a group watching, I'd say this: as bad as it gets, and as much rough water as we're going to have, do you have a feeling that someday we might be able to get on a jet airplane by Delta, get a first class seat, fly down to Hawaii, sit on the beach with a drink with an umbrella in it if you choose, and life will be good again? Heinz ketchup on an Oscar Mayer wiener from Kraft Heinz at a baseball game. Maybe not this year, but you know what, maybe next year or the year after. So if you believe in that long term, that's huge. And I also believe the dollar will lose value. We have been printing a lot of money, which makes the value of the dollar go down. So please watch this right here. Warren Buffett bought some Coca-Cola here in 1985. So let's draw very, very quickly what this box looks like. This little machine, you turn the crank, it sells beverages, and I'll be darned, there's profits here that are divided amongst the shareholders. That's called a dividend. And so Warren Buffett probably isn't keeping his eye on the stock price of Coke so much, but he probably is keeping his eye on the dividend because he's in the beverage business. He's not in the stock trading business. He's in the beverage business in this case. Well, the price tag he got, I'll write a little price tag on here. The price tag that Warren Buffett got way back in 1985, called the cost basis, was $3.25. And the dividend that is paid out today is $1.60 each year. Now, imagine if you had a little jack in the box that every time it did what it was supposed to do, you turn the crank, it comes out with $1.60 and you only pay $3.25 for it. Let's ask this question. If this stock price fell from 325 to say, I don't know, $2. Do you think Warren Buffett would panic and say, well, I better sell my Jack in the Box right away because now the price tag's only worth $2? No. He's going to be calm. He's going to relax. He's going to say, look, I don't know. This stock price might go up to $60, $100, or might go down to 2 or 3. But the thing I do know is that I feel good that I paid $3.25 for it, and I feel good that I get $1.60 out of it. Maybe that's why when he was being interviewed on CNBC and the very nice lady reporting was saying, Warren, what are you going to do? The stock market's crashing. He says, you know what? I feel like we've got some pretty good businesses, and I feel like on the whole, they're making pretty good money for us. And that's his investor mindset. And you'll notice that let's go to Delta right here. Let's talk about maybe Delta Airlines right here. You'll notice that with Delta, we have a Jack in the Box, and it does whatever it's supposed to do. It's a machine. That's all a business is a machine, and gives value to the community. It also pays a dividend, just like Coke, of $1.60. But you'll notice that he didn't buy this back in 1985. He bought this. Oh, whoops, we got to go Delta. Sorry. $1.61. Thank you. $1.61. He bought this in 2016, only 4 short years ago. And what he's banking on, I feel, is that if he can lock in his price where he bought it at, which is, on average about $44 a share, over time with inflation, his cost basis won't change. It'll be $44, but airline tickets will probably be more expensive 10 years from now than they are today, and the dividend will get much higher. So look at his return on Coca-Cola. His $3.25 cost basis, $3.25, getting $1.60, he's almost getting 50% on his money because he doesn't care. And if a person could get 50% on their original investment year after year after year, they probably like that investment. And you can see that he's getting very tiny investor yields on Apple, yet 1 out of every $5 of his stock account is in Apple right now. About 20% of it, you can tell he's thinking about his grandkids in the future. And this investment is not just for me, because I can't give my little college degree to my son. He doesn't get that in the will. And I can't give him any job that I have. He didn't get that in the will. But I can buy these little machines that make money, give them to my son, and it's a huge blessing because as we inflate, that cost basis will be grandpa's or great-grandpa's as these things stay in my family. So any comments you want to make on that idea, any questions on the simplicity of, it's very important, we don't really care about price once we get in. We care about whether it's making money. I'll tell you, if they stop selling Cokes and there was a competitor starting to get market share and Coca-Cola and this number started going down, you better believe Warren would be worried about that. But he's never really worried because when he buys it, he knows that when he buys it, they've got some good earnings. It's a good buy. I'm going to stick with it. Any thoughts on that?
No, I think it's all very clear. And it's so much common sense, right?
Yeah.
And I think that's hopefully what overcomes the panic. I mean, I was talking to a cousin, couldn't take the market going down anymore. She sold all the holdings, took big losses. And of course, some people who are traders are taking those losses to offset gains and utilize it from a tax basis. In her case, it was just pure fear because she's not a trader. She was an investor. And it's the same kind of thing, I think, saying that, if you look at, you gave the example of Delta, we don't know the time, but at some point they're going to be back in business. They are probably going to get support from the government. You can't feel like very vulnerable. You just have to feel like there's just uncertainty for some period of time, but that's going to be a solid company in the future. So anyway, yes, it makes a lot of sense.
I think so. And what you're going to find is it's the cost basis is best. The lower the cost basis, the better. And right now, if you look at this line right here of Moody's, and I'll just highlight this in blue, Moody's, he got in here at $10 right here. And Moody's shot up, and it goes up to 70. Everyone misses the opportunity. Well, in a little bit of a crash, to me, that's my second chance. I didn't get in here, but now I get in here. Buffett paid 44. Delta's 31 right now. Do you see that? And so a guy like me looks at that and I say, you know, if I can get a better price than Warren Buffett, at least that gets my attention, if nothing else, right? If nothing else. So there's a sign. In fact, it's funny that I'm here from my office. If you look over my shoulder, I have 3 signs. You can't see them all right there, but I think you can see one. And so I took a picture of this so you can see a little bit better of what I have here. It's a little sign that says it's a quote from Warren Buffett to remind me every day in my office. He said, "Hey Andy," and I feel like he's talking to me. He says, I said, "Warren, I'd like to be rich someday. You know, I'd like to be richer than I am." And so, how do I do that, Warren? And he says, "Well, Andy, I'll tell you to become rich. Close the door." Got my door closed. He says, "Be fearful when people are greedy, but be greedy when people are fearful." And that seems to fit about like what we're talking about now. I'll be truthful. I don't like the word greed in this environment right now. You and I were talking before that, you know, we have to be so respectful and so tender with how things are right now, because this is real. There's real pain. And so maybe instead of saying be greedy, let's be intelligent, let's be wise, but let's definitely not be fearful right now. You know, bravery, there's a saying that says fortune favors the bold. And bravery from see, here I go. I thought I wasn't going to do it, but you know, I look at my brother Spence out there, putting on his bulletproof vest, putting on his badge to protect and serve out there on the front line. I look at my brother-in-law, who is an ER doctor, and he's older than I am, so he's in that group of risk. He's going out to work every day. So we're not going to be fearful. We're going to join those guys. We're going to be brave for our families. So I would say this, I don't give advice. People are going to have to do what they're going to do, but I will tell you, I do not think Warren Buffett is selling right now, and I'm certainly not. I'm certainly not. What I'm doing that might be a little different is I'm protecting what I have. We're going to talk about how to do that, but I'm actually buying more stocks right now, and then I'm protecting them. You know, I want these stocks in my asset column so they can produce dividends, so I can be in the cola business. We might talk about Kraft Heinz and Delta. These are 2 companies that I'm very interested in. I'm not recommending them for you or anyone else, but I will show you specific trades if you'd like, both on the investor side and on the trader side, on how I use both to protect some of these and also buy some of these. And I think you'll be impressed. It's funny because I've been given a lot of webinars this week, Patrick, and I'll tell you the trades have gotten better since last week. And they've gotten locked down even more than they were last week. And so everything's fluid right now, but I think you'll be impressed. So that's a great mantra. Be fearful when people are greedy, and when others are fearful, don't be greedy. Be smart. Be very, very smart. Still left with the same questions, though. Nobody knows where the market's going to go. No one knows where the bottom will be. How can I create myself a situation to do this? And to learn that, we want to take just a little bit of time here. We're about a third through our time, so this is perfect, actually. We're right where I'd like to be, is to talk a little bit about something called a put option right here. And so if it's okay, I don't think a lot of people are familiar with this. So if it'd be okay, can we spend just a few minutes on this and talk just a little bit about put options?
You're in charge, man. Let's do it.
All right. Let's pretend that this person right here is one of those fearful people. And what happens, and I'll redraw this all again, but I'll tell you what happens to people, is everyone has assets that's listening to me right now, and everyone has bills and a mortgage to pay or whatever they might have. And people have income, hopefully they still have a job, and they have expenses. And it's called a financial statement. What's that called? It's called a financial statement. And what happens is the expense column is always the same. Money's going out. Food, clothing, shelter. When you have a crisis like this, I will show you where the fear comes from and how this works in a person's brain when they think about finances. The first thing is most people that have a job have a source of what we call new money coming in, and that's how they pay expenses. So look at this at 3 cupboards in your kitchen. The first cupboard, you open it up and boom, paycheck, new money. Oh, I can pay my expenses. 3.3 million people last year that we know lost that. It's gone. They don't have it. They're saying, where am I going to get new money? And so they sit together. I'm pardon the emotion. I try to keep composure in this. They sit down. I can see it. They sit down at the kitchen table and they say, we have no money coming in. Do we have any money that's old that we earned yesterday or the day before? Did we buy any gold? Do we have anything in savings? And there is an hourglass of time that they look at, and they look, and the mom looks at the dad, and the dad looks at the mom, and the kids are in bed, and they say, how long we got? And for most people, it's about 2 weeks. It's about 2 weeks. For some, it's 2 months, and then that's gone. And so then what they do, and they're often forced to sell sooner than they want to. They're often forced to sell. And maybe that's this guy right here. Maybe he says, you know, I know that the price of Coca-Cola right now, let's just pretend it's $39. Let's just pretend that. And he says, you know, I've got bills to pay. I'm really scared of not only this dwindling, but the stock price falling of my old stock. So he's not an investor, is he? He's not confident. He's looking at the stock price, but he's saying, I might have to liquidate to pay my bills. And if this thing goes below 35, I'm in trouble. Or maybe he owns a pension fund, or maybe he's responsible, but he says, you know, if it goes from 39 to 38, I can stomach that. If it goes from 38 to 37, I'm starting to feel pain. But if it gets down to 35 and I've got a $4 loss, I got to feel I can sleep at night with knowing that that's where it ends, because I might need that money. Now, if that runs out, the reason he wants that, if that runs out, then you're looking at what we call borrowed money. So you go from new money to old money to borrowed money. And if you don't have any new money and you don't have any old money, like in a 401k or an IRA, anything you can tap, now you start saying, what's our credit card limit? And we say, what's that hourglass look like? And if all three of those go, you've hit the bankruptcy stage. It's very frightening because these hourglasses stare you in the face, especially if you've lost a job. Does this make sense? And so this is this is the financial education I wish I could have taught people a year ago. And I've been a little frustrated because I don't want to use this word right now, because when someone comes hurting, you don't want to call them a Johnny come lately. You don't want to say, well, you know, I was here for you a year ago, or I've been sharing this with people for 10 years. You know, why weren't you? But now's not the time to say, hey, Johnny come late. It's not time to label Johnny come latelys. It's just not. But here we are. So this person says, you know, I'd really like to lock in my price at 35. I know it's trading at 39. I can live with that $4 loss, but no more than that. And he says, I would really like the choice to get rid of this Coke at 35 a share and have a guarantee I could do it. And I'd be willing to pay someone a little bit of that money to do it. Well, what's another word for choice that starts with an O, see? What's another choice? Now, the stocks are traded in New York City on the New York Stock Exchange. But there are contracts called options that help people feel safe as insurance, and these are traded in Chicago. Well, this is where someone like Warren Buffett might come in, and he might say, you know what, I really like Coke at 35. That's a great discount for me, and this is really important. If he sees Coke as a good buy at 35, does he care about the stock price the next day, or is now he in the beverage business? He says, look, I paid 35 on my share. Now let's go sell some beverages. And so since he has the attitude of, hey, I just want to sell some beverages, that's a good price for the business, I'll buy it and I'll live with any up or downs that you know, I'll sit back here and enjoy up and downs, because at that moment, again, that Jack in the Box is producing beverage sales. It's the beverage sales. I own a good business that are selling beverages, not stock price. So he's not going to do that for free. This is actually a real historical trade from Warren Buffett. And we're going to show you guys how we can do the same thing today, right now. And how I've been doing this. So this person says, you know what? I would be happy to pay you an insurance premium to give me some surety. What causes this fear? The thing that causes the fear is uncertainty. I don't feel sure about anything. I want surety. I want certainty. And so Buffett says, I will give you that certainty. No wonder he also owns Geico Insurance. He's very familiar with taking the risk. Oh, I'm scared I might wreck my car. I'm scared I might wreck my car. Warren Buffett says, well, you know what? I'm not scared you'll wreck your car. Tell you what, give me a little premium, and if you get in a wreck, I'll pay for it. So Warren Buffett is greedy when people are fearful instead of being fearful when people are greedy. Well, unbelievably, the premium that was paid on this was $1.50 a share. Boy, that's powerful. I mean, if you can really think about that, that's a powerful, powerful idea. Watch this right here, $1.50. Now, if you look at Warren Buffett's financial statement, Warren Buffett has $35 in cash. He's got that, $35 in his asset column. He has the ability to make that promise. So if you're a person, and we'll talk about the people that don't have as much cash in the second half, but if you're a person who has a little cash, this might be something to think about. I don't give financial advice, but I had a friend of mine call me, Patrick, and he said, Andy, I'm lucky. I liquidated. I was nervous when I first heard about Corona. I liquidated everything out. I'm just going to sit on this cash, and I'm going to wait for the bottom. And I said, well, how do you know where the bottom's going to be? He goes, well, when it starts changing direction. I go, well, it's been changing direction up and down, 1,000 up in the Dow, 1,000 down in the Dow, up 4%, down 6, breaker. How do you know when the bottom is? He goes, well, I don't know. I go, I'm not going to tell you what to do, but I could, I have a class called the 4 Pillars of Investing. And I said, I could show you what you learn in that class. And one of those things is that if you've got a little cash right here, maybe it looks like this for income and expenses. Maybe off this 35, you say, you know what, I'd like to collect a premium of $1.50. Maybe I'll put that in blue so it's consistent. I'll collect a premium of $1.50, and because I have 35 to keep the promise. Now, let's just bring up, just for fun, and this is astounding, and don't tell your friends about this, because if you tell your friends about this, they will not believe you. And you know what? I always congratulate people for, like, in Money Revealed. The fact you were willing to watch myself and some of my colleagues in Money Revealed deserves congratulations. And the reason that deserves congratulations, there's people that are honest and people who are not. There are so many people out there that talk and talk about valuing education, about wanting to get better, about personal development. They talk and talk and talk, and yet they're not here, are they? And yet you and I are here, aren't we? So don't try to tell your friends about this, because they won't believe you. And if they were really sincere and honest about learning it, where would they be? They would be here with you and I. So great job on being here. If we bring up people aren't going to believe this. When I show you this, people don't believe it, but it's true. If you take $1.50 right here and you divide that by the $35 you have to keep the promise, the return, let's do that right, $1.50 divided by $35 even, that's 4.2% on your money. Now, Patrick, right now, banks in a bank account aren't paying 4.2% a year. And get this promise in this case is probably going to last maybe 2 to 3 months. That's it. So we'll call it 2 months. That's 4.2% on that $35 in 2 months. That requires a multiple of 6 to annualize. So to get the real annualized rate of return in that 2 months, we have to times this by 6. That's the return annualized that brings. And these returns are real, and they're even higher right now because there's so much fear. People will pay top dollar right now for you to ensure this price that's lower by $4 than it is today. So let me make sure everyone understands that. And if you have questions, Patrick, go ahead, because other people might have the same question as you. But let's review what we've done.
Basically, what you're saying is, if it doesn't execute, you're going to get the $1.50, or you're being paid to commit to buying at a certain price.
Yes.
So it's so it has a little bit of the too good to be true scenario. What's the downside?
Well, let's finish the trade and then we'll look at it. That's a great question. Good. What is the downside? Mm-hmm. Earlier, I said that there'd be a moment in our time together that we'd say it could go up, it could go sideways, it could go down. We don't know, but we need to be in a position where we feel good, right? Mm-hmm. And so let's see if we can get to that moment. Let's draw all three. Buffett takes the $1.50, he puts it in his pocket, he's got 35 in cash to keep the promise. Let's say that the stock goes up. It just takes off and everything's fine, and we hit a bottom right now, it goes up. The other, we don't know. The other, it could meander sideways. We don't know. And the other one is it could go down a little bit. In fact, it could go down a lot. It could go through here and clear down to go to zero. I don't know. I don't think Coke's going bankrupt. That might be a little extreme, but any of those three could happen. Well, let's think of it this way. You pay car insurance every month. I've seen your car. It's fast. It's good. I like your car. But you probably didn't wreck it. You know, you might have drove a little fast, but you didn't wreck it. You don't get your premium back for the promise of insurance, do you? It's expired. Yep. So the insurance company keeps the premium. So if the stock goes up, you know, 39, 39.50, 40, 40.50, 40, 41.50, 42, whatever, this simply expires, and this person doesn't have to sell. What's another word for choice that starts with an O? Option. It's his choice. So he says, you know what? I'm glad I paid the $1.50. I slept well at night, but my stock is up here at $43 a share. I'm certainly not going to sell it to Warren Buffett at 35 if it's worth 43. But Buffett keeps the money. Now watch this. Buffett's probably not going to do one share. That's not his style. He's a little bigger than that, isn't he? On this particular trade, he said, I want to do 5 million shares. 5 million times $1.50 is actually, let's have some fun with this, that's actually $7.5 million. 7.5 million. Because 5 times the $1.50 is 7.5 million. So he keeps the $7.5 million if the stock goes up. And that's why I told you, don't tell your friends, they won't believe you. They'll say, yeah, I was with Patrick and Andy learning about this. Buffett made $7.5 million on a stock you didn't even own. Sounds crazy, and yet it's true. If it goes sideways at 39, of course he's not going to sell at 35. He says, dang it, you know, God, I spent $1.50 on that insurance. I didn't need to, but at least I slept at night. Buffett keeps the 7.5 million. If it goes down a little, he gets the 7.5 million. If it goes down far enough, he gets the 7.5 million plus he gets to convert this into Coca-Cola stock, 5 million shares, which is what he wanted to do in the first place, and he gets paid 24% annualized rate of return to do what he wanted to do anyway. So up, down, or sideways. So before we talk about the risk in this, let's sit back and understand that there's uncertainty. I don't know if Coke's going up. I don't know if it's going down. I don't know if it's going sideways. But I'm okay with any of the scenarios, and I've set myself up where I can deal with the uncertainty. So if it goes up, I make 24% annualized on that money, or Buffett does. If it goes sideways, he makes it. If it goes down, he makes it. Plus, he gets to buy the stock at the price he wanted. So my message to people is, if you want to try to get educated quickly, you know, this is the type of stuff we teach in our 4 Pillars course. And if you want to catch this up really, really quickly, okay, maybe you get to pick what prices you want right now, and maybe someone will pay you handsomely to get them. In fact, maybe we could give some real world examples. But before we do that, let's answer your risk question very quickly. Watch this. This is hard for people to understand. If you bought it at 39, what's the risk if you just buy the stock at 39? Well, the stock could go to zero, couldn't it? It could go to zero. That's your risk. It's 39 bucks. But if you promise to buy at 35, the most you could lose is $35 if it goes to zero. So promising to buy it at 35 is $4 less risky than actually going out and buying it today at 39 because of those price differences. Isn't that interesting? But here's what else is interesting. You actually also got a $1.50 premium, so now your risk is really $33.50. So what's hard for people to understand is you're taking a bird in the hand and you're giving up 2 in the bush on the rise of the stock price. If you're willing to give up on the rise of the stock price, and you're willing to be an investor and focus on beverages with Coke rather than upward stock price of Coke, well, this is actually less risky than buying stock by itself, which is really hard for people to believe, but there's a reason Warren Buffett's Warren Buffett. Any thoughts on that at all that you want to, did that make that fairly clear?
It makes a lot of sense. One of the questions I have is, why would anybody ever just buy equities as compared to playing options in this way?
Well, the reason is they're traders and they want the upside of the stock, right? Warren Buffett doesn't get any upside of the stock. The most he can make is the $1.50 that month. If he buys a stock and it goes to $50, he gets that upside. But here he's focused on cost basis, and his max upside is limited to $1.50. That's the most he can make. But considering the return on that cash, and that he doesn't care about stock price after he buys it, he cares about dividend after he buys it, that's the difference. That's the difference. Great question. Great question. Yeah. So the question still remains for the viewer, though. Well, great, Andy. But how do I pick what stock to buy? Why not Delta? Why not Royal Caribbean Cruise Line? How did he know to do Coke? And then how did he know that 35 was his spot instead of 34 or 31 or 36? So we're still left with the same thing. I don't know where it's going to go. We're still in the same place. So that's why we do the 4 pillars. And I'll just do this very, very quickly. The first class I recommend that people take if they want to learn from me, and that you can learn from anyone you want, is the 4 pillars. And what I do is I show people how to look at that financial statement. You know, we have people, I can look at your financial statement, know where you are in 5 minutes. Income, assets, liabilities, just like I did before, right? Person loses their job. Okay, how much they have in their asset column? Oh, that's gone? Okay, what credit they have? I can literally tell when they're going out of business. Well, the same is true for nations, the same is true for companies. So this is looking at the financial statement of a company, their assets, their liabilities, their income, and expenses. But I'm also going to be using the chart today. We'll get into this. We're going to be using the chart today. And then this is just information, and then I cash flow. So in this case, I sold a put option for cash flow, and that's the position I took, right? And then finally, this is for sudden change. Hey, if something changes, I have to be ready for that sudden change. And those are the 4 pillars of investing. That answers this question, for me anyway, of where I want to go, what I want to do, and how I want to do it. So if I could we do some real stuff that I've been doing right now? Would that be cool? Let's just do some real stuff.
It would be a rare and gratifying experience for somebody who's teaching to actually show their own stuff.
I don't make recommendations. I don't make earning claims. I don't tell people, oh, you're going to make $1 million. I'm just too smart for that, hopefully. Education only. So the thing that makes me nervous is people are fearful, and they'll cling to anything right now. So I recommend people do this. Of course, the trade I'm going to show you is done in a real account. But notice I'm in a simulated count. And coronavirus is not going to go away tomorrow. You know, these low prices, I don't know, like I said. But if it were my mom or my brother I was teaching, I'd recommend practicing this risk-free in a simulated first. Is that fair? If we proceed forth, that they're not recommendations. I don't like people saying, well, Andy's buying it, so I'll buy it. So here we go.
How do people access the simulator?
Any brokerage. This happens to be an Ameritrade, but Interactive Brokers, Options
Great.
Express, Schwab, they all have fake accounts that they can give you to practice in. They all do. Great. And I have a fun little class I always throw in with people called the Beginning Investor Boot Camp that shows people how to set these up as a beginner. So let's get off our fear gauge here. I'm going to show you ExxonMobil. And if we look at the history, clear back ExxonMobil. In fact, let's even see if I can get a little more of that. Is that all it's going to give me? Let's see if I can even expand this out a little more. If I can, just get really maxed out here. And in fact, before ExxonMobil, let's just take a step back and let's go to crude oil and look at crude oil. And this is back to 1983. And I'm just going to do my very best to draw a line right about here as straight as I can. It's not going to be perfect, but about as straight as I can. And you can see that at $40 a barrel, there's resistance here. There's resistance, resistance, resistance. And finally, about 05 is where it breaks through. And now we have support here at 40 a barrel. I did not know it was going to break support. I didn't know. I didn't have a crystal ball. So I was dead wrong on this. Dead wrong on this. And but I'm thinking, right around $40 is where, oil hangs out above $30 or $40 the last 15, the last 5 years down to 05, 15 years, even though it hung below there before that. So I think, what? If oil gets down to $40 a barrel, I might take a look at ExxonMobil. And I see some interesting stuff here. I see almost a correlation here with ExxonMobil. If I just move this around just a little bit, and I say, oh my gosh, look at that. It's almost the same thing. So I think to myself, what would be a great price here? And remember, just 2 minutes ago, what skill am I using right now? This is a very basic technical analysis. We're looking at charts to help answer the questions of, okay, great, what do I buy and when and where, right? I'm not guessing here. I'm using this is basic, but I'm using a little bit of technical analysis. And I said to myself, I said, well, let's look at the past 15 years. So we'll do this as quickly as we can. Let's look at the past 15 years, right about like maybe this. And I see a line right here. I say, huh, right about here. Bam, bam, bam. And I say support, 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 support. And in my brain, that's what I thought might happen. So I thought my buy price is probably $55 a share. Now, Patrick, I didn't know coronavirus was going to happen. I didn't know. I mean, I'm looking at this thing. I had no clue. I didn't see this coming. I had no crystal ball. I'm looking at my chart right about here, thinking, thinking I'm at 70. Maybe I can get it at 55. So I did the same thing that we just did with Warren Buffett. I did the same thing. I made a little chart here, and let's make it a little cleaner. If something's worth doing, it's worth doing right. As I said to myself, okay, right now, maybe it's at like $65. That's where I think it is now. I'd be willing to buy down here at 55. So here's Andy. And here's someone else, Joe Investor. And Joe Investor says, hey, Andy, I'm nervous. Will you make me a promise to buy this stock at $55? Yeah, because I would really like the choice. What's another word for choice that starts with an O? Option. I would really like the choice to sell at $55. And I said, how much you give me for it? And the market said, we'll give you 55 cents. That's all I got was 55 cents. But watch this for a moment. This was for 2 weeks. That's all it was. The premium was, it was a very short-term trade, 2 weeks. So my financial statement looks like this. I got $55 of cash to keep my promise. I didn't do 5 million shares, Patrick. I'm no Warren Buffett. But I had some money on the sideline, and usually for someone of my trading, I think I got a lot of stock, 500 shares, 1,000 shares, something like that. So I said 500 shares I'll do. So 55 a share, and I get 50 cents in there. Well, look, that's 1%, isn't it? For 2 weeks. So I got to times that by 26. See that? I got to times that by 26. So look at this. This is nuts. That means in a 2-week trade that I'm getting 55 cents divided by $55 to keep the promise means I'm getting about 1% for 2 weeks. Well, 1% for 2 weeks, I got to times that by 26 weeks to get a year. That's an amazing, same return as Warren Buffett. Same one I got as Warren Buffett. So people can do this. Well, guess what? This turned out to be a storm. This got scary. All of a sudden, it hit 55 pretty quick, right about here. And stuff got real. Stuff got real. So you know what I did? I flipped over on the other side of this trade, and I actually bought a put for 3 months till June. Watch this, Patrick. At first, I was receiving the premium. This guy is the one that feels what? Fear. Right. And so I said, and what's he really doing? He's protecting himself and guaranteeing him another word for promise is guarantee, isn't it? And so he now has a guarantee that at 35 is the farthest it can go down for him. He can sell at 35. So even if it went down to 30, Warren Buffett still has to pay him 35. And so if it's down at 30, his insurance actually makes up that $5, doesn't it? It makes that up.
So just to be clear, they call it a put because you can put it to somebody else.
Yeah, you can stick it to him. Put it to him, right? And so right. He can take this stock and he can put it to Warren even if it's down low. Well, I'll show you something that's more realistic right here. Let's just go. I decided to buy insurance on this now that I own it at 55. I decided to buy insurance on this. This is in my real Kansas simulator, but I went out here clear till June, right here, and I bought on ExxonMobil, XOM. Let's see if we get some data here. I went out to June, and I had the $55 strike. I barely sold it yesterday, but I'm going to show you something. The value of this, the intrinsic value of my put, and I just sold it yesterday because I'm happy with my price. Look at this, $55, good till June. The intrinsic and extrinsic value of that combined is $18.15 plus the time value. It's about $1, so we'll call it $19.15 times 500 shares. So that investment, if you look at the difference between my $55 strike and the $36 price right now, is about what? About 19 bucks. You see that? That put cost me $5, Patrick. So I get to sit in my office calmly, and I just know that I don't know how far down ExxonMobil is going to go. I don't know the answer to that, but I do know. Let's get all the carnage in here. I do know that I sold mine yesterday. I felt pretty good about where I'm at $35. My new cost basis on my Jack in the Box is however far down it goes plus 5, and then I lock it in. So I was very happy with this trade that I didn't know it was going to go down. I got paid to buy it at 55, and then I insured at 55. So what I was saying earlier is that my mode right now is not to be a seller of stock. My mode right now is not to be a seller of stock. My mode right now is to what? Is to buy new shares. I bought at 55, but then I protected it in case it went down further. And my mentality for this trade is one of an investor, not a trader. It's to get a cost basis that's low so I can give this stock to my kids and my grandkids and keep it cranking out the dividends. It pays a dividend right now. We don't have time to quite go to that because we want to get to some trading here. But I've done this on ExxonMobil. I've done this on Delta. And the one I'd really like to share just before we close out investing and go into trading is one on Kraft Heinz right here. You're going to look at Warren Buffett. He owned Heinz, then they merged it with Kraft, and he said, you know what, we made a mistake. We paid too much for it. But I'm going to show you an awesome investor trick to take that cost basis, of right here, $30, let's say. I'm going to show you how to take it even lower if you want to see. It's one more thing we can show. And guys, please feel the burden that Patrick and I have. Look, the market crashed 2 weeks ago. I've been doing this a long time. I've been a student for a long time. I don't even like to be called a teacher because I'm still learning. But please understand, if you don't understand every single thing that we're talking about, please understand this is 20 years of study trying to give it to you in 90 minutes. Can you feel the weight we feel? So really what we're hoping to do is someone says, you know what, this seems learnable. Maybe I could start learning it, and maybe this is a solution for me. Maybe it's not for you. But I think there's a lot of people it may be. So I'll show you. I started trading Kraft Heinz a year ago with my business partner, Mike, and also Corey Halliday. And I'll just bring up Kraft Heinz as an example right here. And let's just bring up a daily chart with 2 years of time. And where Kraft Heinz got my attention, Patrick, was right here. And I mentioned the 4 pillars of investing. My first class I took on investing was about $2,000, and that I learned that in this I learned what I do now in that very first class. So it's paid me a lot. I've had winners, I've had losers, but I learned to look at it right there when people were fearful. I saw that gap a year ago in March, and I asked myself, what is it about that fundamental analysis, that balance sheet I didn't like? Well, the problem I saw is there was a problem here in their debt. They had way too much debt. And then I looked at their asset column, and it was inflated. They had put brand equity higher than it was. So we had it. Maybe I could draw it better for people like this. This might be a more simpler way to put it. So I looked at this, and I saw a frowny face. I didn't like it. I looked at this. I saw kind of a frowny face. I didn't like it. I looked at this, and they were selling ketchup, and I liked it. And so I did a fundamental analysis on that. Why is Warren Buffett looking at it? Well, the SEC put an investigation on him because of this, and it went down. I said, man, if Warren Buffett, his price was at 30, it's getting close to Buffett's price. I like this. And we found out that they fixed this one. And watch this. I do have to show this. I know I'm moving fast, people. There's just so much to know, and it's a burden to show. But I think it's important to bring this up. Let's go to dividend.com here in real time. and I'll show you something fairly impressive, I believe. Let's go to KHC. Not impressive in terms of fundamentals, but just cool that we can see it. Right now, if a person tries to buy this stock at this price, they're getting 6% dividend. And notice that 70% of their money is paid out to the dividend. That means they got a cushion of 30% of their earnings, so they can pay off their debt. This is what Warren Buffett said in his letter to shareholders. They have enough money coming in that they can pay 70% of the earnings and still pay this dividend, and people are still buying food. You'll notice that chart is not as drastic as the market has been, because food has been more resilient than airlines right now. And with that extra 30%, they can service their debt. And that's basically what Warren Buffett said in his letter to Berkshire Hathaway shareholders. So I said, you know what, I like this. So what Corey and I did, my little trading buddy and I, in our joint account, about a year ago, we started selling these puts. And if you don't understand it completely, there'll be time for us to learn it. But notice right here that I sold this put. I got a $1.22 premium with a promise to buy at $32.50. So I promised to buy at $32.50, which is this green line here, but minus the $1.22, that's my actual cost basis there. I kept it. Notice the stock did not go below that, so I just kept the premium. Do you remember when we had that graph of Warren Buffett up, down, or sideways? He didn't care. Well, this one went sideways, so I don't get my stock, but I do keep my premium. So this is what people don't understand. I'll just do it again the next month. So I did it again the next month. And now because I had a $1.22 and another amount of money from the last month, that carries over. I don't lose that cash. So I did it again and got 260. Didn't get it. I did it again, came back up. I got 312 now. I did it again. It landed in the middle. I got 383. I did it again. Now I'm up to 413. So you'll notice that because of that up, get paid, sideways get paid, downward get paid, I'm collecting premiums up, down, or sideways. And I only get the stock if it goes low enough to buy it. Below this. Because I'm adding premium after premium after premium, my cost basis is dropping. My cost basis on this stock right now with my partner, Corey, he emailed me and told me, is less than $20 now. So I actually, if I were to buy more of this, okay, I'm actually getting it clear down here cheaper than it is today by cost basis. And if we continue to do this, our hope is, there's no guarantees, but 4 years down the road, 5 years down the road, we own this free and clear. We've reduced our cost basis to zero as investors. Now I really don't care what the price of the stock is forever. I just care about that dividend. I know that was a lot. Learn it. Learn how to do it. It does take some time, but it doesn't take 5 years to learn how to do. So with that, that's some of the stuff we've been doing on the investor side. Maybe now we can talk about the trading side. Before we move to the trading side, any other questions on this investor side and what we're doing, Patrick?
No, I think it's clear, and as you said, the mechanisms or the machinations around it, will require a little more training. But the concepts are what's important now. And to me, the hope is that people would say, oh, rather than freaking out and thinking very one-dimensionally, do I buy now to get in on it? Do I sell now to get out of it? You got to realize that having options is a very safe way to navigate the waters. And if you can understand how to trade in these options or invest through options, you're taking very little risk, and there could be potentially very big upside.
You have given people, I get emotional. Golly, it's just, I apologize.
Don't apologize.
You and Jeff have given people beautiful information on health. And on March 2nd, I went to the doctor with this, fever and all this. And, on February 29th, I was feeling bad. And I went into the doc on March 2nd. He says, Andy, okay, swab your nose. Okay, you got the flu. He says, Andy, I'll tell you what I'm really concerned about is, you're a little heavier than you need to be. And what I'm really concerned about is the risk of diabetes that's in your family. And he says, I know there's corona coming, and I know all this stuff is, coming down the pipe here, but you know what, you need to start losing some pounds. And I thought, I wish I'd have started 2, 4, 5 years ago, but even though there's coronavirus, I'm pretty happy. I'm down, about 8 pounds since this thing started, not because of coronavirus, because my doctor said, Andy, it's time to catch up. It would have been better if you'd have stayed your athlete back in college at 5.9% body fat. That would have been ideal. But you know, here you are today. You're here now. You're here now. Let's not become pre-diabetic, Andy. Let's start now and start doing things now. And what a great message. So maybe if you're maybe financially not as happy as you'd like to be, maybe it's time to get going and let us, give you a little spur. We can help you. We can help you fast. So let's talk about trading a little bit. This is going to be shorter because I'll be quite frank, this takes a little more education. This takes a few more weeks to get a hold of. So we're just going to go very quick. Can you pick a stock for me, any stock you want, Patrick? Just pick a stock, any stock, pick a card, any card.
Let's go back to Delta.
Okay, let's go DAL. And let's go Delta, and I'm going to uncheck. We actually have trades on this. So this account, this simulated account is not my real account. It's called our Mentor Club account. I trade this once a week in the morning on Monday with Noah Davidson on my team, and we just hit the record button like we're doing right now. We hit the record button, and we show how the trade works, and then I send it out to all the members of the Mentor Club every single week, and they follow along in their own simulated trading account. I will tell you, we have gains, we have losses. I can show you here where, here we're down 2,000 and here we're down 1,000 and here we're up 4,000. And people like this is the KHC, which we're holding because we don't care. This is investment position where we don't care about stock price, but this is when we do care about stock price. It's gold, right? So we have winners and losses like anybody else, but we get to learn from both. So it's pretty cool. So let's just look back at this Delta Airlines and let's just say that we were going to buy it. So let's just go in and buy some. Okay, let's pay the ask and let's just buy it. And this is called a risk graph. So to understand the last 10 minutes we have together, we want to know what a risk graph is. And this should be pretty simple. This is the stock price. I'll get my other pen out here. This is $30, $40, $50, $6. That's the stock price going up. $20, $10, all the way down to zero going down. Is that pretty clear? Just give me a thumbs up if it is, and I'll know that you got it, okay? And then this is how much we make or lose. So if we're to buy Delta today at about, looks like it's trading about, $20, $30 or so, boy, we got 100 shares here. Let's see if this works. If we go up $10, we should make $1,000. Look at it, it worked. See that? If we go up another $10, we should make $2,000. We have 100 shares we're buying. If it goes up $10, we make $1,000. $20, we make $2,000. $30, we make $3,000. The problem is always the same. It's always the same. I don't know what direction it'll go. I don't know where the bottom will be. I don't know how long the price will last. So actually, if it goes down $10, we're going to lose $1,000. Goes $20 down, we lose $2,000. And that's the damnable misery of trading stocks without knowing how options work. Make sense?
Yep.
So what we did is instead of trading this stock, we started out, and again, that to buy that Exxon Mobil at 55 was about $27,000, somewhere around there. A lot of you don't have that laying around, right? To do the same for me with Delta was probably around, let's see, $15,000 or so. So here, we're going to do something a little different. We're actually going to start right here by buying a put, okay? So we're going to buy a put right here, and that's going to cost us a risk of $1,000. So I'm just going to circle this. So no trades start risk-free, but we started with this trade. Right here, you'll look in our risk window that we can lose, and it costs $1,000 to this trade, $1,005. Make sense? $1,005. And so that's a little bit more palatable maybe for the guy that says, geez, I don't want to buy Delta. I don't have enough money to buy a lot of Delta. That's not a very big jack in the box for me. Can I make money, though, because I think Delta might fall? And we thought Delta might fall on coronavirus. And so almost everyone listening, if I say coronavirus, Delta Airlines up or down, all of them said down, but they don't know how to do it. So we put $1,000 in this, and then what we started to do was to change this trade around a little bit, okay? And we started to put on different types of options to lock down this risk. Now watch this, Patrick. In fact, let's bring in some time here. Now my max risk is about $300 if it gets above here. But my gains are now $4,000. Now watch this. We said, now that we've made $4,000, Maybe we can, we turn that 1,000 into 4. Maybe what we do now is become investors and buy stock. Now watch this. We buy stock. Let's see if that'll update for me. And now we have a risk graph that has huge ups. Oh, my stock. Oh, we must have sold it today. We don't have the stock in there today. It must have sold. So now, but now we still have a risk graph with very, very good upside, and we don't have much downside. And for Delta to get by April and June to get back up into the 50s is probably not as likely. This is the standard deviation for it. So as traders, what we're going to do is take small amounts of money and create nice risk reward ratios. Let's look at another. This is called Square. And with Square, we're also risk-free. Now, we didn't start risk-free. We started here with a $655 risk. Can you see that in the window? So no trades start risk-free. I've got to really be strong on that. Andy's not saying every trade's risk-free. I'm saying we use the options to lock it down. Now watch. We think it's going down because it's a retailer. Less people out, less people using the credit card Square, less people doing nails, less people cutting hair. That type of Square transactions going down. So we spent $655 in the Mentor Club in our virtual account to buy a put. It goes down. That put is now worth $11,000. Now watch. We get another short option in there. We cap our downside at about 16,000, and the most we can't lose anything. In fact, the worst we can do, no matter where Square goes now, no matter where Square goes, the worst we do is it goes up and we make $1,103. Best case scenario, it goes down, we make $16,000. Here's the bigger picture. Both as an investor, we had a situation with Warren Buffett where it could go up, down, or sideways, and he was comfort either way it went, not knowing where it'd go. Here we also, that's as an investor. As a trader now, we also have a situation where this could go up, down, or stay the same, and we're happy no matter which way it goes. Why? Because we've locked down the risk. So we do these trades every week, and people subscribe. We send out the video. Sometimes we make money, sometimes we lose. Let's just do one more IBM. This is a fun one that has worked out nice for us. IBM, and you'll notice, oh, this is where we did it, not Delta. This is where we did it. So we started off here with a $1,000 20 risk. We put $1,000 at risk, guessing IBM would go down. It did, and we wind up here up about $12,000 in the trade. So $1,000 risk. And please listen to this, everyone. I don't want to be a beggar, but please listen. These returns are bigger than we normally get because the market has moved. I wouldn't want anyone to think this is regular. This time right now with this volatility is what's causing these big returns. Normally, it's nothing like this. But we start to lock it down. Now we're risk-free. The worst we do is $280, and right here, it can go down forever. And we said, let's go from being traders to investors. This is the magic I want on Delta. I click this. Look at that risk graph. So now, if it goes down, look at the money go up here. If it goes down, if it goes up, look at the money go up here. And so we now have this sucker locked down to where the worst we could possibly do by the end of April is make $5,665.49. Right now it's at 10 grand. Looking to make about that expression. Goes down, we're making money. Goes up, we're making money. And the only reason we're able to do that is with our options financial education. So, we're going to try to do 90 minutes. I was moving. The message I have has always been the same, whether it's now in a time of crisis or in times of calm. I'm just so grateful to mentors like yourself. Jeff is just a huge, I'll get emotional if I talk about it. I am not where I am today without Jeff. I just love him so much. And what Robert Kiyosaki is teaching me, Kenny McElroy, the Rich Dad Advisors, guys like Dan Merrill, so many mentors in my life that I just feel that they prepared me through the last few crashes to react to this well. Hey, I've had some trades that have lost money too, but I'll tell you, on the whole, I'm very, very happy and grateful for my own family. I just hope I can help other people, but the learning curve it's a little steep, and it's time to get going.
Yeah, so I know that this was to a degree drinking from a fire hose.
For sure.
I think what I wanted people to understand is that there's how can I put it, more than one way to think about what's going on right now.
Yes.
One thing we do know is there is fear and there is volatility. And those two things are going to create one of two things, either paralysis or action and opportunity. Paralysis to me is the enemy, but I also don't believe in blind action, saying, oh, let me just go do something, because that probably, I prefer you did nothing than run down a blind alley hoping for something good to happen.
Yes.
So it requires a certain amount of understanding. And what we know, as I'm talking to you right now, what we know is that varying people have varying levels of expertise. I have some familiarity with options. Certainly, I don't have anything near the level of familiarity and experience that Andy has. And it's possible you might have a lot of experience and you're like, this was motivating. Maybe I should really spend more time thinking about this. Or you might say, I saw enough to tell me that I want to learn more, because, listen, we're in a very fluid situation. Every day things are changing. I have never in my life seen the kind of swings I've seen right now. Suddenly they're in, and you can see how much emotion is here. Announcements about the stimulus package being signed. Boom, the market's up. 2 days later, some other news, it's down. I mean, I'm talking 2,000 point swings one way and the other. It's really kind of almost incomprehensible based on my experience to date in my life and what I've witnessed. And I've witnessed a lot. I've run companies through the dot-com bubble, 9/11, the 2008 downturn. And there's some fundamental similarities, and there's also a very big difference as far as what's going on here. I will say that there are no guarantees. There's certainly, no way that anybody can predict what's going to happen and when things are going to happen. So I'm a big believer. I think one of the most genius things ever written was the Serenity Prayer, right? And basically, what does it say? God, give me the serenity to accept the things I cannot change, the strength to change the things I can, and the wisdom to know the difference. I believe in what you just laid out, Andy, is the fact that that we can change or control, if you will, our risk and our upside in options, and we can do that on a continual basis. And it's something that if you somehow, if you were in an account, a retirement account, whatever it might be, and you saw a lot of wealth evaporate, don't get greedy and try to just get it all back, but start to say, I cannot control what the markets are going to do. Nobody can. Nobody knows. Who could have predicted all this when it happened? But what I can control is maybe measured responses that I can manage my risk and get back. So, and I know, there's people talking about varying ways to do this, things to consider, in multiple dimensions, precious metals, real estate, options. There's things to consider in all these areas. But the one thing I believe that Andy, you brought here with a lot of heart, not just a lot of intellect, but just with your feeling is that people are scared, people are hurting, and you want to say that you have a special area of expertise that can maybe help them. And I appreciate the fact that you brought that here today. And I know, like you, I'm feeling a lot of gratitude personally, just that I'm not horribly compromised right now, in these very destabilizing things. I do know that there are people who are, recluse with multiple people in small spaces and limited money that they had that they're feeling the pinch of. So, our hope is that somehow we can get people to start believing in a better future. That's going to be coming, and if somehow we're getting that message across, I feel like we're doing our job.
Well, thank you so much. The Serenity Prayer couldn't be a better time. You're right. I can't control the market. That's in the stuff I have to accept, but I can control my position where I can buy and sell. I'm gonna know that difference. And the last thing I would have to say is a lot of people wanting, what is my asset? What is my asset? Certainly there's opportunity in all the asset classes all the time, but our greatest asset right now is each other. Our greatest asset right now is our friends and neighbors. And I get lumps in my throat when I think about the friends I have who are on my team and helping me. It's each other. So thank you so much for the time to allow me to share what I think I know about options and investing.
Thank you very much for doing that sharing. And you're right. I'm basically saying, it's interesting. In the beginning of this year, Reveal Films picked the theme for the year. I like to pick a theme every year. This is our driving theme based on the prior year. What do we need to do this year and how are we going to grow? And the theme this year was collaboration. And I believe that what we really do need right now is to collaborate with other family members, with our friends and neighbors, with other business people, and that through collaboration we can solve problems on a massive scale. And I appreciate your collaborating with us today to be able to get this information out into the marketplace. So thank you very much. And for you who are watching, we are thinking about you. Maybe we don't know you specifically, but I can tell you we are thinking about you, and we're thinking about everybody in this world that's trying to find some light at the end of this tunnel. And hopefully what we brought here was some light today. So thank you very much for tuning in.
Thanks, Patrick.
Take care now. One of the most important interviews I think we're going to have for Crisis Investment 2020 is with the gentleman who's with me right now, Mike Dillard. Mike, you've talked about this scenario, I think, in the past that there could be something that comes that causes this type of an economic collapse. I don't think it's how can I put it, an absolutely out of the blue surprise to you, but I do think you've been thinking about it enough that you have some context. So thanks for taking the time and coming to talk with us.
Absolutely. It's a fascinating topic today. So glad to be here.
So can you maybe just start out, like, just some of your views of what's happening right now and some of your sentiments around it, maybe in a general way, and then we'll kind of maybe dig into some specific territory?
Yeah, I think it would be most helpful if I started back with my experience around the crash of 2007 and 2008 and what I learned from that. I was very, very, very much into finance and investing and went very deep down those rabbit holes around 2006, 2007. And I studied a lot of people like Mike Maloney and Peter Schiff and Robert Kiyosaki and, you name it, all of that crowd. And a bunch of very smart people were all of the conclusion that what was going on in the financial system was unsustainable and it was going to break at some point. And we saw that break in 2007, 2008. Before that, I'd been buying a ton of gold and silver. And that's what they were big fans of as well. And the expectation was that the Fed and the government was going to have to come out and start printing trillions of dollars to bail out all of these deleveraging, debt-based liabilities. And that's exactly what they did. So the Ben Bernanke helicopter money and all of that good stuff. And a lot of those people thought that was going to result in hyperinflation. And it didn't. Gold and silver went up quite a bit, and then it eventually sold off, but it didn't go up nearly as much as a lot of those folks thought it would. And I always thought that was interesting because they were using, Mike specifically, a lot of facts and a lot of trends and a lot of data to make his argument, which was very sound in my personal opinion. But the one thing that it did not take into consideration was that this would be the first financial crash that happened in modern times where all of the markets were connected electronically. That didn't happen in the 80s, right? We didn't have globally connected markets where people are at home on their E-Trade accounts, and making trades and all of that. So my concern around that was, what happens when a government does not have the incentive to let the market crash, because they clearly don't have that incentive, and they also have the ability to manipulate those markets with an infinite amount of printing, and now with an electronic system that they can literally just go change the numbers in the database if they want to. And Basically that's what ended up happening. You know, the hyperinflation didn't happen. The $10,000, you know, gold and $1,000 silver didn't happen. And I believe that the government, for the most part now, has the ability to really manipulate the markets in whatever form or fashion that they want, whether that's shorting gold futures or silver futures, whatever it may be. When you have full control over a financial database, and you can input whatever you want, it's going to be hard to beat that system. So that was a big lesson that I learned looking back at that crash. And so now, as I've started to look at this situation taking place, and I've started having conversations with a lot of friends, what I've learned is that I can't predict the future. And I've also learned that nobody can predict the future. No matter how smart they are, no matter how much research they have done, we can't predict the future. So I like to think of the future now as essentially a black wall that's right in front of me, and I don't know what's on the other side of it. I can make an educated guess, but at the end of the day, I don't know what that is. And so I don't buy into arguments anymore. I plan for all outcomes. And I think that's the only way to responsibly go about events like this, because you and I can look at all the analysis and we could say, this is what should happen based on what is taking place today. That's what should have happened in 08 as well, and it didn't. And so the same thing could be said for Bitcoin and crypto. You know, I've been investing in Bitcoin since 2013. I'm still a big investor in that. I'm planning to buy more here soon. And at the same time, I'm still making my best guess, but it's just a guess. So ultimately, the biggest risk that people are going to run into is their own confirmation bias. Meaning, every one of us has a way that we look at the world and a bias towards the way we see it. And if you want to know what your bias is, all you have to do is pay attention to the media outlets and the personalities that you're watching, reading, paying attention to, and giving your mind share to. What are the articles that you're forwarding to friends? What are you reading and saying, yep, that person's right? Or what are you seeing that, nope, that person's wrong? And that's immediately going to help you identify which confirmation bias which camp you're in. And we have a lot of that going around with the coronavirus now. We have the confirmation bias camp that this is going to be unbelievably bad. It's going to crash the markets in the world, and it's just going to be absolutely horrific. And then we have the other group that's like, this isn't as bad as people think it is. It's going to be over in a month. Nobody knows which is correct, but putting yourself in either camp and putting money on either outcome is just basically the same as going to Vegas and gambling. And so if you can identify your confirmation bias first and foremost, and see and understand and identify the lens that you're looking at the world through, that is going to allow you to see where your weakness is, because most people don't have the ability to do that. They don't have the awareness to do that. And they end up building up this confirmation bias higher and higher and higher until they go all in, and let's just say on gold and silver. And then maybe things don't plan out that way, and then you lose everything. And so for me, that's the single most important piece of advice I could give to everybody now, is identify which camp you're in, that you do have a confirmation bias one way or another. And then what can you do to protect yourself from yourself?
Well, I think, that's a very shrewd insight, is that you're right. There's the conspiracy theorists, there's all the people who've been, the fiat currency, we have to rebel against it, and here's what's going to happen. All the things that you cited, very real, very valid, and none of us are excluded from confirmation bias.
Right.
It's just a matter, can you be self-aware, right? And can you mitigate its adverse effects? And in some respects, from a moralistic standpoint, having a certain set of values and wanting to invest from those values based on how you think things should be is a virtue. But it's not a virtue if you start to go all in on things because you want to, your will over the system, over the market's will, is you're not going to win that battle.
Right.
So now, given that as the backdrop, because you really kind of lay out what is, to a degree, a dilemma, right? Let's say that I'm a person that has some liquidity right now, and just get a call recently. Hey, sold my house. I've got all this liquidity. The market scares the heck out of me. I'm not sure what I should do. So now the answer, do you have an answer for that person as far as saying, and incidentally, I know you might want preference. Here's what I might do. It might be the wrong thing for you. Or, do you think saying, hey, just everybody sit on the sidelines with your liquidity till all this kind of, abates and then come back in? And
well, that's the challenge, is that nobody knows where the bottom is.
Mm-hmm.
Bitcoin had this huge flash crash down to like $3,500 for a day, last week. And I would have loved to known that was coming and bought more in, and now it's back up to $7,000 already. So, stocks are down, 20+% for the most part. And I would love to know if this is the bottom. If this is the bottom, we should all be investing in stocks right now.
Mm-hmm.
We don't know that. Maybe it's going to go down to 50%, maybe by 50%, maybe by 80%. I remember, I think it was after the crash of 2008, there were some stocks that went down 80 to 90%. And so it might be way too soon to invest in stocks right now, or it might be the perfect time. And that really is the dilemma and the challenge here. And so I think the only way to get around that is to have a plan and to cost average in over time. I think if you try to time it, it's basically you're just getting lucky if you happen to time it correctly. And so the only way to get around that is to not be greedy. Mm-hmm. Okay, we've got a 20% discount on stocks right now. Awesome. I'm gonna allocate 20% of my funds, and then let's see, where it happens. If it drops another 10%, all right, I'm gonna allocate another 20% of my funds. So you're gonna basically give yourself 5 shots to cost average in, throughout the whole cycle, and you're gonna catch the bottom with some of that, and then you're gonna catch it back on the way up again. And overall, you are probably gonna end up with a 30 to 50% discount on your portfolio, which is great. I think the challenge that people run into is they try to time the bottom because they want to get greedy. They want maximum profit, and nobody knows when that's going to be. And unless you are a Wall Street trader or a trader, as your career, you're not going to get it unless you get lucky. So that's something that I think, again, people just need to be aware of. And the saying is pigs get slaughtered. I've found that to absolutely be true. So, if I were deploying my money today, I would just be deploying a little bit of it in gold and silver. It's really interesting right now. Gold and silver is completely sold out as of today, physical metal. The mint is sold out. The brokerages that I've talked to are sold out. Everybody literally doesn't have any metal available per purchase unless you're willing to play a ridiculous amount over spot. And so, you can always jump in on the gold and silver ETFs and things like that. But again, I would be putting a very small amount of money into that right now, 5-10% max. Mm-hmm. I would put 5-10% into Bitcoin. And then I'm going to wait, and then I'm going to see what happens. And, if we see a really big drop in real estate markets, I'm going to allocate probably the majority of my money into cash flow real estate. That's an asset that I would love to buy a lot of and hold for the next 20 years. So for me, that's what I'd be looking for. If I can get dividend stocks at a huge discount, if I can get Tesla at half the price that it is now, awesome. I'm going to buy some Tesla. So that's really the only way to go about it. And that's just the biggest lesson that I've learned over the last 10 years is the first time 2008, I definitely went for the greed button, and I was absolutely 100% convinced that my view and eventual outcome was correct. And in some ways it was part correct, but in other ways it was incorrect. And today I know better than that. So that's how I'm going about it.
That's, I think, really solid advice. And I think the overriding theme is don't get greedy, right?
Yeah.
And if you get greedy again, then you might get lucky or you might get slaughtered. So I think that's a really good context and perspective. And thank you for almost the specificity of this much here, this much here, this much here, as far as saying how you kind of divide up whatever that investment was that you want to make. And it seems like just a very well thought out, not an emotional thing, but just kind of a very thoughtful approach. And as you said, in real estate, in the end, if there's a drop in that market, that it's a buy time, and that's a good place to be.
The trick is how do you save yourself from yourself? Yeah. And We talk a lot about this in the crypto space because that's a very volatile market. And so we talk about an exit plan in crypto. When do you sell? When do you sell your crypto? And the challenge is as your hypothesis starts to get confirmed, let's just say your hypothesis is that gold is going to go to 10,000. As it starts to hit 2, and then 3, and then 4, and then 5, and then 6, as your hypothesis gets more confirmed, it solidifies that confirmation bias, and you become more right. And you're like, I knew it, I told you so. And this is what happened with a lot of crypto holders in 2017 when Bitcoin hit 20,000. Is no one wanted to sell because they were just being reaffirmed that they were correct on a daily basis until the day that they weren't. And then they lost in a substantial fashion. And so as you start to feel like, hey, this is correct, and I'm starting to see that I made a good bet on this, that's actually when you want to start getting concerned instead of excited. Because, okay, this was right, and now this is going to be right until there's going to be a moment where it is no longer correct and it's going to correct. And you have to have the discipline and or a system that will take the emotion out of that for you, because that's going to be a very emotional period. You're going to be celebrating. You're going to be cheering yourself, patting yourself on the back. And it's going to be the hardest thing in the world to sell when every single thing is telling you that you're right. So the way that we talk about that in the crypto space is we just have targets. The moment let's just say, make X amount of return, let's just say double your money in crypto, you can do that in, 2 or 3 days with some of the smaller altcoins because the market caps are so small. Awesome. Then you take your principal out and then you can let the rest ride, or you take the principal out plus 20%. And so you made a 20% gain no matter what. You're going to feel like you won no matter what. And now you can let the rest ride and go for some larger gains. But then you also have just a system in place. Okay, if it hits this price, I'm taking 20% out. If it hits this price, I'm taking another 20% out. It's that price, another 20% out, right? So again, we're going to do the opposite that we did the first time, buying in low. We're going to do that when we're trying to sell high. And we're just going to ideally give ourselves 5 exit points around the top of that bell curve. So we'll get it on the way up and we'll get some on the way down. And overall, on the average, we're going to do really well. But you need to put those triggers in place so that it allow you to make a decision that's not based on emotion. And you have to follow that system, because if you don't, you're like, oh no, I think it's going to go to 20,000 gold now. That's when you're going to run into trouble. So how do we save ourselves from ourselves?
And the flip side of that is, if you did cash out and it continued to go up, don't feel bad, feel like you won. Because some people, again, that's the whole thing. It's hard, right? It's like, oh, I did too early. No, you made a lot of money. You start
calculating what you could have made if you had only left it in longer. Yeah. And that's a really hard thing to get over. But if you lose a lot of money because you stayed in too long, then you'll appreciate that the next round. I hope people don't have to wait 10 years to learn that lesson, and that they don't have to learn it the hard way. But yeah, so gratitude is really essential and key around that, because it's so funny. You could triple your money and beat yourself up about it because you didn't 5X it, right? But that's a real thing. So I'm glad you brought that up.
Yeah, and interesting in my own personal experience recently, I have a son who's graduating college with a finance economics major, and graduation's canceled right now, school's done. But I have been managing, because I want him to understand this, a small brokerage account for me. And, and I feel lucky. I don't think this was necessarily smart, but I was on, before everything started to tank, I was on a call as things were starting to brew, and with a friend of mine who's kind of an influential guy, who said to me, "Oh my goodness, they just canceled Expo West." This was before all the other things canceled. And I was there last year. I'm like, that's 100,000 people. That's the entire town of Anaheim. They just canceled the whole thing. So I literally got off that call and I called my son. I said, I think you should sell everything now, because it was. And so I got out. It was great. And again, what if it didn't tank? I wouldn't have been. So I'm feeling lucky. I'm not feeling smart. Right. But he did something. But to the point of what you're making, as I explained to him why I think we should do this, and he agreed, because I wanted it to be his decision, because I want him to learn from this. he got out, but then he took some of the money and he shorted an airline.
Mm,
And I
great.
said, and it's a smart move. I didn't think of it. He did. And so 2 days later, we're looking at that short, and it's way in the money. I mean, a lot of profit in it. And I said to him, I said, why don't you, I think maybe come out. He's like, no, I think you can go further. I said, you're getting greedy.
Mm-hmm.
We just got a little bit lucky, and you made a smart move, but don't try to think that it can keep running forever. At a point when you feel like and it'd be better if we said there's a step point, which is what we agreed to. We said, okay, how about it hits this mark and then you come out, as compared to thinking it could go further. So to your point, it's exactly right, because if we didn't put in some kind of a rule and a mark and just stuck to it and agreed to it, anything could have happened that would not have been good. And and the trick is, as you said, if the short, if we had held on to the short longer, which we got out of, and made more money, which we would have, I still feel great about the fact that we made what we made.
Yeah.
So
yeah.
So really, really sound advice. And this goes to what's interesting is how much of this is psychology, how much the market crash is psychology. And I keep saying this over and over, but I think, at least at this point, fear is spreading faster than the virus. And it's creating a lot of, upheaval that the virus never could. So the psychology, you're bringing sort of this equanimity to the mindset of how to think about this, which is something that I very much appreciate. So can we now say, okay, what if you're an entrepreneur or business owner and things are frozen? Oh my God, everything is just stopped. Do you have any advice for them?
Yeah. So it's the same exact thing. You start by identifying where your confirmation bias is around this whole event, specifically around how long you think it's going to last. Mm-hmm. Because that is going to determine your actions and your decisions. And so if you think it's not going to last very long, well, you might not change anything, even though sales are down, revenue's down. You might be even losing a little bit of money, but you think it's going to be over in a couple of weeks. So you don't change anything. You don't reduce staff pay. You don't let staff go. You don't reduce spending. Well, if it doesn't end next month, and if it lasts another 6 to 12 months, you're going to be out of business, or you're going to then be forced to, and you're going to be put in this very reactionary stance where then now you have to react to the circumstances and you have to make a very fast short-term decision that's going to have long-term consequences, which is the last thing in place that you want to find yourself when it comes to making decisions around a company. On the other hand, if you think this is going to last 12 months and you start to lay off your team now, even though you've got 6 months of runway, and it does clear up in a month, well, then you've just blown up your whole business. And so we're using the exact same process in our businesses, meaning I don't know how long it's going to last. And if I try to even attempt to guess at a date, I'm just really gambling and throwing darts at a dartboard, which is not a way to operate a company. And so, going back and again, looking at lessons learned for 2008, you want to reduce and get rid of emotion. Emotion is the enemy. Emotions breed bad decisions. And you want to buy yourself time. Time is your friend. And so the more time you have to outlast any of these market conditions, the better you are. And so how do you buy yourself time? Well, you look at how long your cash flow and your runway is as a business owner. Do you have 30 days of cash on hand? Most restaurants, I believe, have 16 days. Service-based businesses, less than 30 days. Half of U.S. businesses have less than 30 days of cash flow in the bank right now, which means, we're 10, 12 days into this from a quarantine perspective or shutdown perspective. A lot of those businesses are going to be out of money in the next 2 weeks, unless they get some form of bailout. I know they're trying to pass these stimulus packages to provide relief to small businesses. We'll see if it happens. Can't count on it. But if that's the situation you're in, okay, you need to fire everybody, or as many as you can, and reduce your expenses as much as you can to give yourself a longer runway and stretch that out from 30 days to at least 60 days. So the first thing you want to do is really just take an accounting of what's our runway, how long is our runway at our current burn rate. And then you want to start setting milestones that are based on, let's just say, cash flow levels. So if sales drop to X amount of percent, then we make this decision. If it drops to this amount of percent, then we make this decision. And so you're planning this out ahead of time, and you have a plan no matter what happens that, again, is not based on your emotion. It's based on an event and a trigger. What that does also is it allows you to get your team rallied around making sure that you don't hit those milestones. Hey guys, if sales drop, or if revenue drops, another 20% this month, everybody's got to take a 30% pay cut, right? If it drops to 50%, everybody's taking a 50% pay cut, whatever it may be, to guard that level, if you will, to keep everybody operating. If it goes below that, then we have to start laying off staff. And so when you bring and rally the team around those goals, they'll start working as hard as they can to make sure you don't hit that point. So that's how we look at it and we operate around it. It's just event-based milestones, around cash flow levels, burn rate, knowing your numbers, knowing what your monthly expenses are, how long of a runway that you have. And then you don't have to worry about how long this is going to last. Now, once you've done that, how do you turn this into an opportunity? As you know, money is just a representation of energy. Energy is never destroyed. It is simply transferred one form or another, one place or another. So a lot of businesses are losing a lot of money right now, but that money is flowing into other places. It's flowing into companies like Zoom and Netflix and YouTube and entertainment and all of these other products and services out there, toilet paper companies and sanitizer companies, right? So it's going somewhere. Trillions of dollars are being deployed by the US government right now. That money is going to go somewhere. So how can you solve a problem that this crisis is creating for somebody and use that as an opportunity to make money? So that's what we're doing with our business. We were getting ready to launch a new mentoring product for entrepreneurs the first week of March. And I saw this kind of coming. I'm like, if this does get bad, which it looks like it's going to based on all of the data that I was seeing here in the US, then this offer is really going to be out of context. We talked about that earlier. We all have some videos that just would be out of context right now in the general public conversation. So our product was going to be as well. So we decided to stop on that agenda and we totally switched gears and we're like, okay, what are the biggest problems that our customer base is going to have during this time period, and how can we solve those? So that's what we've spent the last 3 weeks essentially building out and creating our solutions to the problems we see in the marketplace now. And, our goal is to get those up and live here in the next week. So, the thing you want to consider around that though is how can, whatever pivot you make, how can you somehow make that pivot to where it is not completely abandoning your current and previous business model. It would be like you leaving the documentary space and going and making hand sanitizer, because the problem with that is this challenge will come to an end. We don't know when, but it will come to an end. And if you stray too far from your foundation, then you put that at risk over the long term. And so that's something that I want everybody to keep in mind as you make these small adjustments to your marketing message, and the products or services that you may be offering, is how can you pivot them 10 to 20% so that they're relevant and useful now without just throwing it all out the window and doing something completely different from scratch.
Yeah, I like that advice a lot. A couple of comments I have relative to it is, I'm old enough now. I mean, I was, running companies as CEO through the dot-com bubble, same company incidentally. Then 9/11 happened, and then 2007 happened, that crash. And so, and if I were to look back and say, because we're having these conversations now with my partner Jeff, saying we both, were in business through these varying eras, and we said, let's not repeat any of the mistakes we made when in 2007, 2008. We did some things right. Hey, a lot of people went bankrupt. Worked through it. got the company back on its feet, and I sold it in 2011. But it was a very, very bad time. And the biggest mistake I made is, I think what is similar to what you're talking about, is I held too long waiting to see what's going to happen, or thinking it might turn around, and I didn't want to let go staff and so on. And but at the same time, we're working with leasing companies that leased our technology and equipment. In a week, all three of them were bankrupt. They were out of business. Mm-hmm. We had, our pipeline froze, et cetera. But, so I stopped taking salary, and then, keep everybody on. And it was, I waited too long to act, so I'm looking back saying, okay, I waited too long to act. So now this time we're acting much quicker, but much more rationally, in the sense of saying, how can we transform? Because I said the edict, so saying, what's the vision? We're going to have to reorganize our plans that we had for the year, because we set out our objectives. We had all our things done. We have big investments in projects that we're going to have to sideline for a bit. But what's the goal? The goal is that we're going to reorganize as a company, and we're going to figure out how we're going to end up actually even more profitable by the fall, because we made really smart decisions and did the right things. Yeah. But what you said, what I think is really important, because one of my business rules is never take opportunity over values. Right? Mm-hmm. And you gave the perfect example, saying, "Oh, hand sanitizer. Yep, you have nothing. Our business has nothing to do with hand sanitizers. So suddenly, don't go running after an opportunity. It has nothing to do with our company, our values, the value we want to create in the world. So if you happen to be in that business, good for you. You got lucky. But we're not going to try to ride that kind of luck. It would be a misfortune, actually. So I think that it's saying, what value do we bring, and now how can we, in today's context, how can we add value? The thing I loved about what you said is, how entrepreneurs, and how just in your own business, your own thinking, I believe that it's the entrepreneur that is going to turn this around, has to basically save the world, because we are able to make those kinds of decisions, pivot, and keep adding value and find ways to serve people in that way. So I love the way that you laid that out, and the sequence of it, and how you're thinking about it personally for your business. And all I can say is that not only abstractly did that land for me, but based on past experience and being through things before, it's very sage advice. But one other follow-up question I have for that, I just wanted to validate what you said. But one other thing that I wanted to ask is, do you feel that what is happening right now, and I know this is just your own feeling, but do you feel like what's happening right now is similar to past things like 2008, or do you think that it's a different animal we're dealing with?
I have removed myself emotionally from this basically in every way. Mm-hmm. As in, I went, down in the 2008, I went super emotional down that path where I bought the 100-acre ranch off the grid. Mm-hmm. I bought the food and the armory and the gold and all of that stuff, right? So I had a lot of emotion around those times, and it was, mostly excitement, because I felt I had an understanding of what was taking place more than 99% of the people on the planet. So I looked at that event as an opportunity for me, and I did very well. I pivoted my business. I started a new company in about 60 days that made $3 million in its first week, solving a problem that market crash had created. On one hand, I did very, very well. And on the other hand, I made a lot of mistakes on the investment side because of those same emotions. And so now I look at this with that hindsight, and I'm like, I'm not putting any emotion to this whatsoever. Again, because I think emotion is the enemy in any of these scenarios. I think it clouds the mind. I think it clouds the decision-making process. I think it is the ultimate sign of confirmation bias if you have an emotion around something one way or another. And so I don't really care, what's happening in the world right now. I just care about how can I find a problem and create a solution for that, because that's what I know how to do. I know that's what creates opportunity. I know that's what creates financial prosperity. And so that's the only thing that I'm focused on at the moment. And if it gets really, really, really bad, we'll deal with that when it comes. But if that's what I think about, then I make my decisions now based on that expectation that, again, might end up not coming true or being incorrect. So I'm right in the middle, completely neutral. Whatever is. I'm making my plans with basically a good, worse, and bad, or good, bad, and worst case scenarios. And we're creating products and services right now that only become more valuable and in more demand the worse things get. But they are also just as valuable and just as in demand if things get better. So that's the approach that I'm taking right now, is we're creating products and services that will be relevant no matter what happens either way.
Quick question circling back, because some people, you talked about cryptocurrency earlier, and maybe some people want to go play in that space, and it's highly speculative, but they're like, I got some liquidity. I think there's gonna be some swings of volatility. I want to get in and play, and I'll lick my wounds if I lose, and if I win, I'll be happy. Yeah. When you go in, and I'm looking at that basic approach on how you invest, and I mean, really getting at what platform do you use for trading, crypto, and just your methodology, if you can share a little bit of that.
Well, again, I've bought Bitcoin since 2013. I've put hundreds and hundreds of hours into studying different crypto projects in the markets and use cases, far more than 99% of the public. And so my approach is going to be quite different than anybody else's. But I'll just say this: I have about half of my crypto is in Bitcoin and Ethereum, which are the two grandfather projects of the crypto space, if you will. They have the highest market caps, the highest liquidity, the highest adoption rates. So those are your two safe bets. If you don't know anything about crypto, then I would just put whatever you want to invest into Bitcoin, half Bitcoin and half Ethereum, and just that's it. You're done. You have your bases covered. You can do that at Coinbase. If you're in the US, is probably the easiest exchange you can do it. You can get on Square's Cash App now and buy it right off your phone in the Cash App. And Bitcoin's also coming to your mutual fund, into your Morgan Stanleys and all of that stuff here. So that's how I would go about it if you're not educated in the space. If you are educated in the space, you probably don't need my advice on this, but we use other exchanges that have smaller project called altcoins, which is essentially anything other than Bitcoin, that are essentially like internet startups, if you will. Like they're really tiny. They're super, super speculative. And so if you can just put a little bit of money, even if it's just $100, $200, $300, $400 into these projects right now, as the markets go through these giant bull cycles, whether those coins have actual use cases that and adoption or not, they tend to get just traded to enormous levels. And so you might be able to buy one of these projects for 2 cents now that, you could exit, for $1 and make a 50x gain. So it's highly, highly volatile, but you have to wait and you have to be patient. I think right now, this is, close to one of the lowest points of this 4-year Bitcoin cycle. It tends to run in 4-year cycles that we're at about the halfway point. The halvening, if you will, starts here in just another month or so. And that is essentially programmed deflation in the Bitcoin ecosystem, meaning the amount of Bitcoin distributed from the mining process on a daily basis is going to get cut in half. So instead of the Fed printing more money than they can possibly manage, trillions of dollars right now, Bitcoin is increasing the money supply. Bitcoin's doing the opposite. The Bitcoin supply is decreasing. It's a deflationary currency. It's a fixed number of Bitcoin that will ever exist. And so as supply decreases and demand increases, that means price goes up. So it has so far traditionally run through these 4-year cycles when that deflation kicks in and the price goes up accordingly between 10 and 20x. Will that happen again this time? I would assume so. If looking at the past patterns and what it's done so far, we have no reason to think that it will do anything different, especially with the policies the U.S. and essentially the world are putting in place to respond to this crisis right now. But at the same time, Bitcoin is the enemy of the Federal Reserve and the U.S. dollar. if they have an unlimited printing press, they can short Bitcoin into oblivion. It's the same thing that I saw in 2008. So will that happen? I don't know, and that's why I do recommend that people treat this as a highly speculative investment opportunity. I talk about the Vegas rule. Don't invest any money into crypto that you wouldn't be willing to lose at a table in Vegas. So as long as you keep that in mind, I would absolutely put some money into crypto, Bitcoin and Ethereum to start. And the other exchanges that we like to use are Binance for altcoins, Bittrex, Kraken is another good one. So, but that's stuff I wouldn't mess with unless you really educate yourself on this industry. I would just stick to those primary two. Don't make financial decisions based on emotion. Don't think the world is going to fall and sell all your stocks. Don't think that this is going to end next month. We don't know what's going to happen. You don't know what's going to happen. So make a plan for every eventuality. Write that plan down and follow that plan. Don't break it. Don't make an exception because it's turning out that your scenario was correct. Just like your son's example, which I think is the perfect example. And that's it. I think at the end of the day, if you come through this without losing any money, you have won. You are one of the lucky ones. If you happen to make money on it, you are one of the very lucky ones. You are one of the absolute few, the 1%, who will make money during this market crash. So I would set those as your expectations.
That's great, Michael. I have to say that there's no substitute for wisdom and experience. You've seen a lot, you've experienced a lot, and understanding not only maybe just strategy, but the psychodynamics behind how to be. Because I've repeated this a couple of times during these interviews, because I'm getting people calling me, what do I do? What do I do? Should I do this or should I do this? And I'm like, you're asking me the wrong question. The question you should be asking me is, who do I need to be right now? And I think you answered it brilliantly, saying you need to be someone who's not going to make purely emotional, investment, decisions. You're not going to be someone who is blind to their own confirmation bias, but you need to be a different kind of person in this circumstance that can make very rational decisions and have a plan. So I appreciate you bringing that context and that wisdom to this conversation.
Yeah, you're very welcome.
So I will wish you well through all of this, however long all of this is, and I'm sure we'll be in touch over time. But thanks so much for making time for us today.
Thanks, Patrick. Thanks for having me so much. Thank you all for watching.
Well, that's it for episode 2 of Crisis Investing 2020. Remember, there's still time to share this with other people. Let people know about this. There was amazing content, wasn't there, in this episode? So happy to share this with you. Tomorrow in episode 3, we have Rick Sapio and Alan Aquina. And let me tell you, those are 2 phenomenal interviews. With Rick, he's a very forthright thinker. He knows how to battle through tough times. One of his expertise is in doing corporate turnarounds. So for many people, this is going to be a financial turnaround, and his insights, I think, are very powerful. And Alan Aquina is a common sense, put it on the ground guy. Great concepts that he shared with us, things I think will make you feel better about the future and give you some ideas on how to take action. So I look forward to seeing you in episode 3.
There's a saying that I had for about 20 years now, and don't let a good crisis go to waste. Use this as an opportunity to transform the way you think, to transform the way you act, to transform your rhythms, maybe change careers, I don't know. But the fact of the matter is, what can you do now? And what you could do now is make sure you have a solid financial foundation and start building that right now.
So the rich get richer after a downturn, after a crash or a crisis. Why? Because they're not operating on fear. They're operating on logic. When looking for opportunities, finding financial opportunities in a crisis, there's going to be all sorts of things. But we have to really go back to, does it fit in our financial plan? And if it fits, then you should go for it. If it's an opportunity that you find and it fits in your plan, then do it.